Investing, especially after receiving an inheritance, can feel overwhelming. It's important to approach this opportunity with a thoughtful plan. Let's break down a winning strategy. Step 1. Define your goals and investment vision. Are you looking for steady growth over the long term, or are you open to taking calculated risks for higher returns? Your goals will guide the types of investments you make, but it's also important to consider your personal vision for the future. What industries or sectors do you believe in? This will help shape your overall strategy. Step 2. Understand market capitalizations and their roles. Microcaps, under $300 million, are high-risk but potentially high-reward investments. They're often newer companies or in niche sectors. Small caps, $300 million to $2 billion, can offer more growth potential than larger companies, but they come with greater volatility. Mid-caps, $2 billion to $10 billion, often strike a balance between growth potential and stability. Large caps, over $10 billion, are typically well-established companies with more stable, predictable returns, making them ideal for long-term investors seeking steady growth. A varied approach, allocating across these categories, can provide a blend of stability, growth, and exposure to different market opportunities. Step 3. Focus on key financial metrics. P/E ratio, price to earnings. This ratio shows how much you're paying for a company's earnings. A high P/E may suggest overvaluation, while a low P/E could mean the stock is undervalued. Price to book, P/B ratio. This ratio compares a company's market price to its book value, its assets minus liabilities. A lower P/B can indicate that the stock is trading below its actual value. Debt compared to cash and revenue. Look at a company's balance sheet. How much debt do they have compared to their cash reserves and revenue? Companies with manageable debt and strong cash flow are better positioned to weather downturns and expand during growth periods. Step 4. Manage multiple strategies within your portfolio. A successful portfolio isn't built on a single approach. Invest in large cap stocks for stability and steady returns, perfect for long-term growth. Add mid and small cap stocks for potential faster growth, though these come with more volatility. Explore micro caps if you're open to higher risk for potentially huge gains, but only with a small portion of your portfolio to balance risk. Step 5. Diversify with physical assets. Physical assets often move independently of the stock market, providing stability and protection during market downturns. Gold and silver. Precious metals have historically been seen as a hedge against inflation and economic uncertainty. While they don't generate income like stocks, they can preserve wealth when currencies lose value. Real estate. Investing in residential real estate can offer both income through rent and potential appreciation over time. Agricultural commodities. Assets like wheat, corn, or livestock offer diversification because they're less correlated with traditional stock markets, making them valuable during periods of inflation or market volatility. Step 6. Watch lists and entry points. Create a watch list of companies that you're interested in but don't buy just yet. Track their performance and financial health over time. Look for ideal entry points. Times when these stocks are undervalued or poised for growth based on their fundamentals or market conditions. Step 7. Holding cash and timing the market. Keeping cash on hand allows you to wait for favorable entry points, rather than rushing into investments when prices are inflated. Buying at a market high, when valuations are stretched and optimism is rampant, can lead to steep losses if the market corrects shortly after. By holding cash and waiting for the market or specific stocks to become undervalued, you reduce this risk. Step 8. Recognize market cycles in the Austrian school approach. Understanding market cycles is critical for timing your investments and knowing when to be more cautious or aggressive. The Austrian School of Economics focuses on how credit expansion and monetary policy create boom and bust cycles in markets. During the boom phase, markets are often overvalued due to easy credit and excessive optimism. In contrast, the bust phase leads to a correction or recession, where undervalued opportunities may arise. Step 9. Continual learning and adaptation. The world changes, and so do markets. Stay informed about the sectors and companies you're invested in, and be open to adjusting your portfolio as new opportunities arise. By focusing on different market caps, paying attention to key financial metrics, diversifying into physical assets, and understanding market cycles, you can build a portfolio that not only meets your goals but reflects your view of the future.